Does this yield curve inversion even matter? What happens if it uninverts? And what does it mean for the S&P 500 that's been kind of just stuck in a very tight range? Where are rates going after Fed Kashkari talked? All that and more on today's Stock Market Brief show, the show that I just recorded without audio and now had to re-record. So I'm very happy about that. So make sure to hit the thumbs up. That would be greatly appreciated. That's how you sponsor today's episode of the Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intramarket analysis. Let's get into today's episode. All right, people, welcome back. We got a lot to discuss, and I want to keep it quick and to the point because I am recording again because my audio went out. Yay, I'm so happy right now. Fed Kashkari was out and about. He said that interest rate hikes are not entirely ruled out. He said a lot of things, but that was the headline. And what did the markets do? Well, they remained rather unchanged on the trading session. However, if you take a look at the CME Fedwatch tool, looky over here, the markets are starting to price in the possibility of a rate increase. By how much? Well, pretty much like by nothing. They're still looking at a rate cut, the higher probabilities of a rate cut later into the year, but they're only looking at a 25 basis point cut. So as more data comes out, things may change. We may not even get a rate cut this year, which is a lot different than what's going on here at the ECB, where Lane said that the way is clear for rate cuts with inflation and wage rises on a downwards trend. What else happened today? Well, the 10-year Treasury yield rose above 4.5% following a weak auction, which is interesting to me because you would think that with the negative correlations that we pointed out in prior episodes, it would affect things like the S&P 500 and the NASDAQ or the NASDAQ 100, but they remained rather unchanged. How could it be? Well, it could be because NVIDIA blasted off like a rocket ship today, up another 7%. So a lot of things got taken out. A lot of things remained flat as far as large market cap. And you can see energy over there loves it when the 10-year yield rose. Now, I want to point out this chart where you look at S&P 500 and the correlation between the long-term Treasury yields on a 10-day and 30-day correlated basis. And what you'll see here is a line going through the screen. This right here is the zero line. So when price action is above it, right, the price action of this correlation is above it, that means there's a positive correlated state, meaning that if it's above it, yields rise, and the S&P 500 has been rising on a 10-day, 30-day basis together in unison. However, it's below it. So what does that mean? Well, it means that when the 10-year yield rises, it means that the S&P 500 can go down, or vice versa, right? If the 10-year yield falls, the S&P 500 can go up, which we've talked about in prior episodes. And you'll notice here that the correlated state where it's at, I mean, it's the lowest point it's been for, back to where it was at the early start of this trading year. So what happens if the 10-year yield rises? Well, it's typically good for energy names, which we've seen in the past and just priorly looking at this heat map. But you can see oil rises and it tracks the 10-year yield quite well. The green and red bars is 10-year yield. The black line is oil. And you can see the price momentum oscillator starting to curl back around, indicating that, hey, are we going to come back up to around this prior high at about 4.7%, looking at the 10-year or the TNX, which would be at 47. And if that's the case, does that mean oil rises with it and energy names as well? Well, if that is going to be the case, if the 10-year yield is going to rise, if oil is going to rise, perhaps we can look at energy names. So I ran a quick scan so you have some names to look at. I'm not going to go through all of them. But what I did here on FinViz was very simple. You can go to market cap. I did a large plus. And then I looked at 0 to 10% below the high in the last 50 days. And I looked at the sector of energy. And then I went ahead and sorted them from largest market cap down. And it gives you a list of names in those conditions. Why 0 to 10% or even 0 to 5% below the high? It's because that means those names have been holding up rather well in the midst of volatility in the energy sector. And if they start catching a bid, perhaps the stronger names are going to outshine the ones that have been weaker. So some of the top names is XOM, CVX, and TTE as far as the larger market cap goes. But you can pull up all the charts and make things, work for how you want them to work. Meanwhile, if you take a look at the bullish percent index chart for energy, it is in an oversold condition via the RSI. However, this one is quite chunky, meaning that there's fewer names, and it could stay overbought and oversold for a lot of times. But you'll notice that when it's oversold, it does rotate back into overbought conditions at some point. Okay. Now, let's get a little bit more tactical and look at the 15-minute time frame for energy if you are interested in energy names. So I went ahead and anchored a volume-weighted average price, VWAP, a TWAP, or whatever you want to call it, to the high of the month of May. And you'll notice here we try to get above it, but we broke down, and we're trying to come back above it, but we're right there. And we're right at a declining 5-day moving average. Now, it's always more bullish, right, if this is flattening out to turning back up. Okay, and so what that might look like is something like this, and then you could potentially look to buy into the strength after more of a consolidation. Doesn't mean it always has to happen that way, but what I'm seeing from a price action perspective is constructive right now. Okay, why do I say that? Because we have the low right here, then we have a higher low right here, and we have a higher low right here. In price action, you can call this a potentially inverse head and shoulders as it's kind of flattening out around the neckline, but we're still below that declining, or we're at that declining 5-day moving average. So if you are to go long, you'd be wanting to see this low anchored VWAP hold as a level of support, which is right around 91.87. And then you'd also want 91.08 obviously to hold there too as well. So those would be some of the risk levels that I would be paying attention to if you're interested in the energy sector. Okay, that was a lot. Now let's get to whether or not this even matters anymore. This is the 10-year, 3-month yield curve. We'll look at the 10-year, 2-year momentarily. It's been inverted, well, the longest it's been inverted. I mean, you date back to the 80s, we haven't had a yield curve inversion for this long. And well, every time it's inverted, it hasn't been all too great. You can go over here to the 2020 recession, but we can cross that out because people will say that was the pandemic. Look a little bit more to the left. You got the great financial crisis, you have the dot-com bust, and you also have the 1990 recession. And really, we started running into problems when it uninverted. And that's an important piece here because, well, let me show you. Let's take a look at the 10-year, 2-year yield curve. As people are saying it don't matter no more, right? It's been inverted since, well, I mean, we were inverted here in July of 2022. And it's been inverted, which means what? It means that the 2-year, which is the pink line, is above the 10-year, right? So the 2-year is a higher rate than the 10-year yield. But now I want to call out something interesting on these yields. Notice how the 2-year is rising to around 5%. And the last time we were up there, well, it started to backtrack or consolidate around those levels. Now the 2-year yield, it tracks the federal funds rate very closely. All right, so what this tells me is rates are going to be higher for longer. It doesn't necessarily mean that they're going to be increasing, but right now with that big move there, it tells us, yeah, higher for longer. So the reason that I'm pointing this out is because if we get stuck up here at around 5%, take a look at this prior swing high and this prior swing high in the 10-year. We're well off of that. So is this going to track and try to come back up to its prior swing high and this to pause out? If that is the case, it doesn't mean we're going to get uninverted right away, but in the near term, that would mean that we start to steepen and get closer to uninversion. And why would that be important in the near term? Well, take a look at this chart. This is dating back to when we inverted in the yield curve, the 10-year and 2-year, and you can see the deeper it goes into inverted territory is not necessarily bearish. In fact, it was bullish for the S&P 500 there, and there. It's when it uninverted or started to uninvert or started to steepen, we start to see volatility enter back into the S&P 500. We started to get deeper into inverted territory. Well, we started to rally. Then we started to uninvert again or started to steepen, and we started to flatten out to go nowhere. Then we started to get deeper into inversion, and we started to rally, and so forth down the list. Even recently, we started to get deeper into inversion, and we started to rise higher. Now, the reason why I'm pointing this out is because we saw it steepen today, and the S&P 500 went nowhere. So if I'm right, if we're right about analyzing this, where the 2-year might stall out around 5%, but the 10-year still has room to go, that means there could become a time where we start to obviously steepen here, which could bring more of a pause to the S&P 500. Is it mean that it's absolute and it's going to happen? No, not necessarily, but that's what's been happening in the past, and I'm reporting to you right now about that. Now, if we take a look at the S&P 500, you can see last week's candle was above a rising 5-weekly moving average, and it was a big faddled indecision candle, which means what? It means that the bulls fought one way, the bears fought the other, and they basically agreed to just close exactly where they opened. And this, after a large rally, marks a period of indecision, meaning that the market is preparing for a potential move. And today, well, we did absolutely nothing, but we are still above that rising 5-day moving average. So we're going to have to pay attention to the high and the low, because if we break it, that'll negate, obviously, that indecision. As you can see here, this was the high and this was the low, and this daily candle was quite the bearish outside day, which we've seen in the past, a bearish outside day, and it bounced and followed through to the downside. Does that mean this is what's going to happen here? It doesn't mean it's going to happen, but what would confirm it? Well, a break below it could confirm that, but a break above would negate that bearish specific candle. Now, on this day, we said, do not worry, do not panic. There was panic, right? And well, why? Well, because things were getting oversold, and it was very likely to have an inside trading day or trade back up to where all that volume was. We haven't had the decisive break yet as it stands. It could come, but it hasn't happened yet. So you take a look at the 15-minute time frame on the SPY, you'll notice this big volume shelf over here, and you'll notice that this level is at 530, and price action's been going boom, pinning to that level. We break away from it, but then we come back in, broke from it, came back in, and we've been trading basically at 530. Now, the 5-day moving average, we're above it, but it's starting to flatten out, so the trend is becoming very neutral. If you take a look at gamma levels, 5,300 was in fact, the call wall for a while, and price action really did get pinned in and around that level right there. As you can see, we broke above it and came up to 5,350, which was a level of interest from a gamma perspective, and we hit it to the penny and then shot right back down through 5,300, going into negative gamma territory, but came back. Even today, we came down to the 0-date level that traders were focused on in the early trading session, okay? And then we came right to the gamma flip line. We were in positive gamma territory on this strong move. Dealers look to buy the dip, sell the rip. That's what that means, being above the gamma flip line. When we're below it, that's where selling begets selling, buying begets buying, where you can have some very, very volatile moves. So what does this mean from a trader's perspective? Well, let's take a look at the SPX net gamma as it stands right now. This is the 5,300 level that we just pointed out. And if you look to the left of the screen, there's really nothing out here other than 5,200. And then way over here, obviously we have 5,000, which is the put wall. So below 5,300, I'd be proceeding with caution, especially in negative gamma territory, for potential fast breaks to the downside. However, above 5,300, I'd still be bullish and trying to target that 5,350 and potentially even the call wall up here at 5,400. Okay, so just to make it very simple, very, very easy, very plain. But as we get more data, as time moves forward, our trading decisions are going to have to adapt and react and respond to what is currently happening in the markets. If we take a look at the 11 sectors that make up the S&P 500, I just want to follow up with this. Notice that the majority of all the sectors are below the purple line, and the purple line is declining. That is the 5-day moving average. So we have XLY declining. We talked about energy and how it's trying to recoup it, and how it could be a positive sign if the 10-year yield is going to start to move, right? Where we might see this flatten out to go up. That's a possibility. But if we start breaking levels, then, well, that's out the window. Okay, financials, it's getting a little extended to the downside, but below a declining 5-day moving average. It's technology that's holding this market together right now. And you can see that's above its rising 5-day moving average. XLC is also above a neutral, flat 5-day moving average. It's XLB, XLV, XLRE, XLP, XLB, XLU. They're all declining 5-day moving averages. And that is why we're seeing the 5-day moving average kind of flatten out here. So what does this mean? It means that if the 10-year yield rises, we've already known the negative correlation, right, can affect the S&P 500. We know that the larger market cap names, right, are tech names, and the rising 10-year yield, that means that some of these names could potentially back off. And if they back off, we might look for a rotation into various different areas. That's all I got for you on today's episode, everybody. We covered a lot. Hope it helps out.